Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome once again to Taking Stock, and welcome Art Jarvis to another edition of Taking Stock.
Hey, happy to be here.
Happy to have you once again. And I know since the last time we talked, you had a nice little vacation. So, for the folks at home listening.
Yeah, had a nice little vacation, and which is always good. Just go and relax a little bit. But unfortunately, that as Kim always says, I don't know how to take a vacation. But it was good for me. Let's put it that way.
Well, you're refreshed and ready to go. Plus, when you take a vacation, you boost the economy. So that's what we're here for anyway.
Yeah, it's interesting you say that, because that was because as I think I said 2 weeks ago, I'm burdened with everywhere I go, I'm looking at things from a different perspective, right? But you know what? The restaurants were full. The condo place where we stayed was completely full. Everywhere we went was full and busy. So to me, that's a good sign. So reinforce that Peter Lynch theory I talked about a couple weeks ago.
Very good. Yeah, well, that's you look around and see what's the economy look like live and in person,
Correct,
as opposed to just numbers. And I know you have some numbers for us. Well, I don't want to say numbers, but you have some updated information, I guess, quarter.
Yeah. We just finished up the second quarter, and the 10,000 view of it is things are going well this year, which is good, because really the last 3 years have been, we'll say, difficult. But if you look at the S&P 500, which is 500 stocks, which is the one I look at because it's a little more broad based, it was actually up 8.74% in the second quarter. So that's a very good thing. The one thing we talked a couple weeks ago, though, was about a weighted index and an unweighted index, though.
Right.
So if you're looking at things, say, how broad-based is that move up? So again, S&P was up 8.7% in the second quarter, but the unweighted index was only up 3.5. So it was definitely driven by a smaller number of stocks or a few sectors, as opposed to being across the board.
Wider broad band.
Exactly.
Yeah, I got you.
Yeah. Year to date, the S&P 500's up almost 18%. But the interesting thing is, if you equal weight the stocks in the 500, it's only up 6.1%. So that is definitely a much bigger spread. And I think the one thing I wanted to point out is, what was the big driver? And really the big driver last quarter and this year has been the technology sector. Now, in fairness, the technology sector took a severe beating in 2022 with interest rates rising, which is not good for technology stocks. So they need to come back a little bit more than some of the other sectors. But the technology sector so far this year is up almost 40%. So it's up 39.75%. So that's definitely the driver this year for the stocks. Not other sectors are up. But.
And is that a thing where, with investors or clients of your own, to suggest to them, hey, now's a good time to maybe jump in on some technology stocks, or because it's up, it's like, hold what you've got. Yeah. And wait for it to drop a little bit and buy in, because obviously we always come back, at least when you're talking with me, to buy low, sell high. So if they're up, maybe now's not a good time to jump in. But what do you tell an investor in terms of the technology market?
Well, first of all, you go back to 6 months or more ago when they were down severely, and you're starting to look at a situation where hopefully the Fed is going to start to ease up on the raising of the interest rates. So that really was the opportunity to kind of start dipping your toe back in, maybe for some people, and for other people, just get back in, depending on their risk tolerances and things like that. So, really the time to get back in was 6 months ago, but that doesn't mean now is necessarily a bad time to get in. I think, if we have another rate increase or maybe quarter, we're still looking at it. I think we're still looking at where the Fed is going to stop raising rates here, and then that is good for the technology sector. So I still think the technology sector can continue to move up. Now, it might need a little breather after being up 40%, but we'll see how things look. But the earnings numbers are good. That's the other thing that's coming up is we've got earnings numbers coming up. So we'll see how the technology sector fares there. But again, it's two things. One, it's clients' risk tolerances, right? So you might put a little bit of technology in one client's account, and another client's account you might put a big chunk of technology because they're willing to accept the volatility that comes with that.
Right. So. Well, has that been, just a side note for me and for whoever's listening in, is technology typically, those stocks are more volatile? I mean, they're kind of up and down. That's what, from me as an outsider, not knowing the business, but that's kind of what I see. So I don't know if that was an accurate picture or not.
Oh, very, very much so. Technology is going to be pretty much your most volatile. There's 12 sectors in the S&P 500. Yeah. Technology is pretty much going to be your most volatile. I mean, we talked a couple of weeks ago about NVIDIA was up 25% in one day.
Yeah.
Typically Procter & Gamble doesn't go up 25% in one day. It's just kind of one of those chug along kind of stocks. But it has a higher dividend yield. It's more of a value oriented company. That or a bunch of other companies like that. Whereas technology is definitely growth oriented. And the reason that they're so volatile and why the interest rates have such a big impact is because their cost of capital. So they're growing, they're building, they're developing new things and all that. Yeah. And their cost. So if we go from 0.5% interest rates to 5% interest rates, their cost of capital and their cost of doing business just went way up.
Well, technology is more what I just heard you say. Technology is more research and development driven, and so, like you said, the capital is what's important. You've touched already twice on something that I was going to bring up. So what are you hearing about interest rates? Because I'm hearing that, some suggestions that the Fed's in a position to they kind of slacked off, and now they might raise the interest rates a little bit again. So what are you hearing or seeing that says yay or nay to that?
Let's see. Two parts of this. I mean, number one, what you're hearing and seeing is that they're pretty much already pricing a 1/4 point increase in July. So the Fed meeting that I think is the 25th and 26th, I believe, of this month, they're already pretty much priced a 1/4 point increase. Now, are they right? We'll find out in a couple of weeks. But, so that's kind of in there. And then they're talking about potentially another one in would that be September? I guess would be the next opportunity. So there's that. So, but they're 1/4 points and they're tweaks. Like we're in the tweak mode now. Before we were hitting it 3/4 of a point, 3/4 of a point, and the market obviously didn't like that to the point that we dropped 22-23% last year. But going forward here, I'd still look at these as possible tweaks. So that they're not. It's not a foregone conclusion what's going to happen. From the interesting thing to me is month after month after month, we have Fed Chairman Powell come on and speak, and he basically has said the same thing for months. He says the same thing. He says we're probably going to have to raise interest rates a couple more times, and we were worried about that recession word again. Keep talking about that, and that continues to put downside pressure on the market because even if it's a 1/4 point, it makes a difference. Okay, maybe not a huge difference, but it makes a difference in how you analyze things and how you project prices and things like that. That's kind of the word on the street. Now, what perplexes me a little bit is that he continues to say the same thing month after month, but we kind of continue to get the same negative reaction. It's not like you haven't already heard this 8 to 12 times, right? So he keeps saying the same thing over and over again. Yet, and I've mentioned this several times, the economic numbers to me still look fine, number one. And number two, guess what? The market's continuing to go up in spite of the fact. He beats it back down a little bit, and then it comes racing back. We're getting close to new yearly highs again today.
So So even with the, I don't want to say the threat, with the potential of slight increases, which which now you feel comfortable calling them tweaks. If it's a quarter, that's not that bad in the impact. We shouldn't expect it to, make us start worrying about that recession word anymore. What else? What else do you have for us today? I know a lot of things have been happening. It seems like you've got some.
Yeah, and the one thing I do want to make you mentioned the word threat. Okay, so the Fed has.
I didn't want to say threat.
I know, but it actually kind of is though.
Okay.
So they're using that as a tool. So they can raise interest rates. They can increase the banking reserve requirements, which all are ways of taking money out of the economy and trying to slow things down, try to beat down inflation. The other way is what I call jawboning. They can continue to say what they're saying, and just by what they're saying, that puts that downward pressure on things and tries to either take your foot off the gas pedal a little bit or actually tap on the brake a little bit. So they can do that by not doing anything just other than jawboning, than talking. So right. It's a strategy, it's a way of doing it. So if they can accomplish what they want to accomplish by not actually do something specific, it's actually probably not a bad thing. So anyway, just kind of want to point that out. But yeah, the one thing we talk about. So we're up. It's a good year. No matter how you look at it, it's a good year. After last year being down 20-something%, even if we're only up 6% this year, I'll take that.
It's moving back in the right direction.
In the right direction, yeah. Exactly.
We just need to feel it in our bank accounts,
right.
in our back pocket wallet, or wherever you carry your. Well, I was going to say cash, but everything's
right. Yeah.
Whatever your Venmos and everything else, but
yeah, exactly. And again, we're feeling it. I mean, no one you talk to will say, "Oh, I went to the grocery store and I didn't notice anything." I mean, everyone talks about, you walk out with 2 bags of groceries and it costs you $100, right? Wow. Or you go to the gas pump and it's still $3 and whatever, 25 or 50 cents a gallon. So that's higher than it's.
I just paid like $3.40 a gallon. Okay. So it's in that, but like you said, it's $3 to $3.40, somewhere in there.
So you feel that. There's no doubt that you don't feel that. But the question
I like it better closer to the dollar, not closer to the $3 or $4.
Well, back when we were in high school, when we were paying 75 cents a gallon or whatever.
Well, I'm a few years older than people might know, but I did pay 23 cents a gallon.
Yeah.
The old gas wars.
You could put a quarter in the tank and get yourself home.
Amen. Well, of course, 23 cents a gallon, and you've got, 4 miles to the gallon because you had like a muscle car.
That's true.
Or something like that.
Yeah.
But anyway,
that's a good thing.
We're getting off the beaten path.
You're right.
Who wants to talk about how old anybody is anyhow?
Exactly. But the one thing to point out is, so things have been going well, but and interest rate projections have been moving up. But the market recently has been moving up a lot faster than those earnings projections have been moving up. So, you look at a price to earning ratio, so a price of the S&P 500 divided by the amount of earnings there, we finished the second quarter at 20 times. Now, 2 years ago when interest rates were very low, 20 times earnings might not be that big of a deal. Okay, it's not cheap, but it's not necessarily real expensive either. But now when you're at 5% interest rates, 20 is up there. I mean, 20 is a much bigger number at this interest rate level than it was 2 years ago. So you kind of got to look at that and say, are we at some ridiculous kind of level? No. But are we cheap? No, most certainly not. And then you start to look at the forward earnings. So, okay, the 20 times earnings is what's already happened.
Right.
Looking at forward earnings, you look at, the last 2 quarters plus the next 2 quarters, that's at 19 times earnings. So there's not a substantial.
Yeah.
And then if you take in just a full, if you're looking at all of 2024's projected earnings, we're at 18 times earnings. So again, is there room for us to maybe move up still? Yes, as long as all the things keep clicking and all that stuff. But but the other thing is also at 18 times earnings, or on next year's earnings, does that give me pause like we're due for a great big crash or something like that? No, it doesn't. I just think it might be, it might be more of kind of that slow, steady kind of move up and then pull back a little bit and then kind of move up a little bit more as hopefully the earnings keep up or start to move a little bit faster, which is the other thing. Now that we're at the beginning of the third quarter, now we have earnings numbers starting to come out for the company. So that's always important, and it's important to see how many of them hit their numbers, but even more importantly, what percentage of them actually do better than what was projected.
Well, you answered the next question before I ask it, because I was going to say, with the earnings coming up, or what are the things to be looking for in the next quarter? And it sounds like the earnings results versus what the projections are,
right?
Or what the projections were.
Precisely.
That's always telltale. What are the expectations right now? I mean, again, it seems as you're telling the story right now, what I'm hearing is the message is, hey, the economy's moving in the right direction. So probably earnings reports that come up this next quarter are going to look okay.
They definitely. I'm not concerned about them not looking okay. Typically in any given quarter, I'm looking again at historical averages, but typically you're somewhere in that 65 to 70% range of companies that actually report positive earnings, meaning higher than what was expected.
Right.
So that's kind of normal. If you get up into the high 70s or even hit 80%, that means things are really clicking along, and that's when you probably, if the analysts, you start to see the analysts start to bump up the earnings numbers, right? So that's where that would help. If we have a real good earnings season here, much better than expected, hopefully you'll see the analysts kick up their forward earnings numbers, and that'll make this market, even at this level, less expensive. Just from that. So.
Well, I like that less expensive, because at the end of the day, it's the cost of the dollar.
Yeah. Yeah.
And I say it cost of the dollar. Some people will say the value of the dollar. Mm-hmm. But just because of the interest piece of this, I'm making the reference like cost of the dollar.
Sure.
So if the earnings, come out to the good, to the positive, as, seems like we're sort of expecting, then that's going to have a good impact on the cost of the dollar.
That's correct.
Okay.
Right. And which helps gross domestic product.
This is Mr. Simple Terms here. I'm not the finance guy.
Being the economist that you are, I
keep telling you, the problem with us doing this and me hosting and sharing the story along with you is that it should be my wife, Sue.
Right.
She understands this and she gets it and can. She would be probably asking much better questions than I would, but
probably tougher questions. So we don't want her.
I don't. See, there's a reason. Well, she's over analyzing the grocery prices right now. But So what else you got for us? This week.
Coming in the next 3-4 weeks will be the numbers. We'll start off with kind of the what do you call it? Systemically.
The systemic.
Systemic, thank you. The important.
I just needed to find out where you were going.
I know, right? It could have been any word at a moment, but those financial institutions that are important to the system, right? So you're going to have Bank of America, J.P. Morgan, Wells Fargo, all those names are going to come out. You'll have BlackRock report. These are all names they'll be on the front end, so we'll see them here in the next week or so. But you also get Pepsi, obviously a huge company. You'll get United Healthcare, which is a huge company, and you'll get Delta, so you'll get a taste of what's going on in the airlines and things like that. So that's where it'll start.
And does the airline stuff fall into the volatile category these days?
It has for about the last 2 decades, honestly.
Okay, well, there you
go. They're pressured, or they get direction from the price of oil, right?
Sure.
One of the biggest costs is fuel. And if it's there, hopefully they're doing a good job of hedging their fuel costs. But at the same time, there have been times, back in the early 2000s where oil went, from whatever it was, $15 a barrel to $115 a barrel, and that, put a lot of pressure on it. So, yeah. So you look at you look at Delta. Delta just completely tanked back in the early 2000s. 9/11 obviously didn't help at all.
No.
But anyway, these are all companies. They'll be coming up here, but then we'll cycle into some of more of the consumer cyclicals. We'll cycle in, then we'll start hitting the technology stocks, which is what people will pay pretty close attention to. Then we got economic numbers coming up. You know, the all-important consumer price index is tomorrow, I believe. So
in 2 weeks from now, we should have waited a day.
we could, right? Yeah, we could have talked about we taking stock special report. Here
Well, you make sure you put that in your notes for 2 weeks from now, so
don't you worry.
We can go through what the CPI ended up being.
Yep. Yeah, and hopefully it's a continued trickling down of inflation. And then Thursday is producer price index. So consumer price index is the retail numbers. Right. Producer price index is the wholesale numbers. So we'll get those numbers, and then we had the employment numbers. And the interesting thing about the employment numbers, that was last Friday.
Right.
Again, it wasn't what they expected, but I would still argue it was good. Right. So if it's good, that's fine. So CPI, I'd argue that it's still good. I mean, we created 200-something thousand jobs, which is historically is kind of normal, right? It wasn't as high as they wanted it to be, but I still argue, once again, if you're looking at things from a long-term perspective, they're still heading in the right direction. And honestly, since COVID and things like that, my opinion is they haven't really done a great job of predicting the monthly employment numbers in the first place. So they've had some really big misses. So, if it was they wanted 200 or 300,000 and we end up with 200 and something thousand, I'm okay with that.
Well, based on the employment numbers, where are we? Because are we still in this crisis of there are a lot of jobs left open? I mean, especially in like the restaurant industry, the service industry, people aren't taking those jobs, or are they? Where are we on that right now?
Yeah, and some sectors might argue with me, but we're better. We're better than what we were. Most certainly better than what we were. Some sectors have gotten a lot better. Other sectors, if you're still looking at restaurants and things like that, I mean, they're not near as bad as they were, but they're still struggling. Yeah. But it's so interesting. We're sitting at 3.4% unemployment, which is the lowest it's been in a decade. So unemployment is historically low. Yeah, it's good. There's still sectors and companies still out there trying to find people, and you see it every day. We're looking for this. We're looking for that. There's hiring signs in the windows and things like that. So clearly, people are still looking much more than they were pre-2020.
Perfect. Yeah. Well, we will look forward to. And before I say that, is there anything else you want to sum up today? Because I was going to say we're going to look forward to 2 weeks where we're going to get a look at the consumer price index numbers, and what do you call it, the Producer
price index, sure.
CPI and PPI are coming up in 2 weeks when we come back to taking stock with Art Jarvis.
Yeah, hopefully, a exciting report would make for a more interesting episode, but I prefer not exciting.
Not that kind of
That's right.
Not too much.
Hopefully, there's not a whole lot to talk about other than, hey, we're still moving in the right direction, and that's. And again, I think I've said this several times at the end of the show, is I still feel we're continuing to move in the right direction. Okay, now we've gone pretty far, pretty fast here recently, but I still think we're okay. Yeah. The same thing every time. Stick with the plan. Right now, it's stick with the plan. I don't foresee anything, unless someone does something stupid, in our future. So.
Perfect. Well, this has been another edition of Taking Stock with Art Jarvis. And we'll be back again in 2 weeks with the next edition of Taking Stock. Thanks for joining us, Art.
Fantastic. Glad to be here.
Take care.
Thanks.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.